So I've got a number of things that I want to cover, and the ground rules again. If you're new to this, please ask questions. There are only two things yeah. In fact, I muted everybody, but just if you would mute yourself so the background noise doesn't intrude on the discussion while we're talking, and then ask us questions or make observations or share something with us. If you have learned something, experienced something, let us know. I mean, we love to do those kinds of things. Okay, so I've got I think five things that I want to cover today. Um, so I said I posted this on X, so I'm going to address it right off the bat. I said, the market has been very volatile. Unsurprisingly, it's been right in line with what we can measure. And again, if you're new, we look at demand, supply, and volatility. They're the core ingredients to the quantitative approach that we take to equities. It's not technical, it's not fundamental. That's not how the market works. The market is neither technical nor fundamental. It's really mathematical. It's 100% electronic. It's 99% algorithmic. Much of the order flow is executed by order management and execution management systems that are informed by everything out there. Consuming social media feeds is years old. It flows right into automated trading systems. And if machines react the same way, the market can go up or down dramatically in a very short fashion. It's not human beings who are doing that. 90% of the volume in the market is a different purpose and time horizon than active fundamental stock picking. It's a measurable fact. JP Morgan pointed that out in 2017. 2019, Goldman Sachs did the same thing. So that's my tee up to what I want. What could you gather if volatility in the market is 3%? Which is about where it is in the S&P 500, that's 50% over norms. And the market goes down all of its volatility, and then the next day it goes up all of its volatility, 3%, and the third day it finished sort of in the middle. In fact, if you looked at you looked at the S&P 500, the Dow, and the NASDAQ yesterday, they were basically the 1, 2, 3s. Dow was up about 1%, the S&P 500, 1.5 to 2, the NASDAQ 3. And it sort of fits our 1, 2, 3 model. We say that generally, under ordinary conditions, SPY, VOO, IVV trackers, ETF trackers for the S&P 500 have volatility of 1%, much higher than that right now. The basket, 2%, momentum, 3% or more, can be more. And the relationship among those things are how the ETF market makers are guaranteed a return, basically, which is how Jane Street, produced $20 billion in 2024. That number one ETF market maker. And you and I can produce returns on that too. What you can take away from day three, if we land right in the middle of volatility, roughly, is that the baton has been handed off to buyers, from machines to buyers. And you can know which direction you should go. Brian and I probably did very similar things as we did on Monday. We don't talk about it, we just just do it. But I certainly put in long trades. Always hedge, but I was had a sizable position in XPXL. SPXL is a levered ETF. You have to be very careful with those instruments. They can move on you. I only do those things when I know what the demand supply balance is and what volatility is doing. I bought some SPY just because I wanted to deploy some capital. I bought a small SPXU hedge because you never know. The market is not a metronome. It moves around. And so you should always have some protection. Very small. It was 5-1. Because I can look at the demand supply balance and have a pretty good idea which way things are going to go. So that's what you can know. If the market reverts to right in the middle, what that tells you is machines are crossing the bid and the offer. All stocks have to trade between the best bid to buy and offer to sell, and they're never going to be the same. The bid's always going to be lower than the offer. That's the rule. So somebody's going to cross the spread. So if the spread gets crossed and we're halfway between our bid, the volatility range, by the end of the day, you can surmise that there's a pretty good probability that there are buyers there. And that probably means that the bias in the market will be up. Now, I don't know what it's going to do in the last hour. I actually still have a little hedge, and the hedge is underwater. I don't care. It's not material. But if there is some mean reversion, I'll probably get rid of that. And then I'll decide. But I still think I'm going to adjust my ratio, but the market's probably still long. I'll bring the ratio down and I'll explain why. So let me share my desktop and I'll get to the next several things I've got to cover here. Bear with me. Any questions about that? It's not, there's no absolute. There are central tendencies in the market, and that is a very good central tendency to know.
Tim, looks like there's a hand up from Nolish.
Okay. Yes, sir. Nolish, fire away. Nice to see you.
Can you hear me?
Yes, gotcha.
Okay. I'll just say like NVIDIA has like a 50% wall analyzed. So I'm expecting the daily wall is around 3%, right?
Yes.
So
yes, it is.
I'm actually looking at these range of trade, but are you taking these 3% from the open or from the last close?
It's a very good question. So how we calibrate that is we take a 5-day rolling average of all of the stocks comprising the S&P 500 and the average intraday move from highest to lowest price. Not from the close, it's intraday. What's the highest? What's the lowest? That, then averaged. And one could do, we track 5, 20, 50, 200-day reads on those, but it's the 5-day that's very important for short-term trading. Right? You can't use a long-range tool for a short horizon. That's how we do it. Good. Okay. Let's see. Really quickly, I should be. I mean, unless things go haywire on Monday, this may not be true. I'm supposed to be on CNBC with Brian Sullivan in the 1 to 2 p.m. Eastern time hour. I don't know where I'll fall during that time. I'll talk to the producer tomorrow. So it's been a little while since I've done that. You got to be really, really I used to do it routinely. So anyway, it will give me a chance to talk about these things. I expect I will be asked, why was the market so volatile? What went haywire? So I will try to do in a very succinct fashion the stuff we talk about here, right? You've got to do it in like 30, 45 seconds. But anyway, supposed to do that in that hour Monday. Here's another thing. I promise to answer this. And I'm going to do, in fact, there are two things I want to answer. First of all, I had an email about this, and so I'm going to bring it up here. And I don't know, Brian, if you're not Brian Wilson, the Brian who asked this question. I don't know if you're here, but it's a fair question. So he said, you look at the daily trading ideas and it seems like it's too late. The things already move. And I say, don't chase those things. They'll come back to you, and you're not missing out on anything. The only aim that you have is to produce a return on your capital. That's it. Right? And the market doesn't determine that. You do. You make decisions about how you're going to commit your capital. So on Monday, in the hour into the close, I bought Google, the non-voting shares, from the Momentum Daily Trading Ideas portfolio. Demand was rising, supply had trended down. And so his question was, okay, so you do that, but what am I greedy if I want more than a 2% return? I got a 2% return and I was out. But if you look at it now, I mean, clearly it's continued to run. Could you let your winners run? Well, of course you can. I mean, you can do that. How would you know when you should leave? Well, there are, to me, 3 things that should prompt it. Number 1, a downtick in demand. That's a reason. I mean, it's at I think it's at 158 today. So I bought it at I don't remember. It was like It was one. I think it was 146 where I bought it intraday, and I made my 2% on that and left. Well, now it's at 158. Could you stay in? Well, A, you could use this as a signal. This is where the data was today to take your gains today if you're in it. B, you could stay and lessen until it drops below 5. That hasn't happened. Or C, if the supply side jumps above the trend. All those are reasons to leave. I mean, you need a reason to exit. Entries kind of take care of themselves. I think of course, you could argue the opposite. You could argue entries are the hard part, exits are easy. But I wanted to address that fact. Secondly,
Tim,
yeah.
while we're on the topic, if you don't mind, with the daily trading ideas, like today's a good example. Sometimes names can get away from you. And I had an email on this topic this morning. If a name gets away from you, obviously you don't chase it. Let's say it comes back the same day. Is that still a good buy candidate that day?
Yeah, it's one of my. I love those opportunities. And Brian, you agree? I don't know. Do you agree or disagree? Let the price come to you, and if it comes into your entry range, the reason we're buying these things is because of demand supply asymmetry. I'm going to move out of this and just go over here and make this point. If you pick I like some of these, particularly when there's momentum in the market. Some of these, lower price stocks can deliver a really nice return because you're looking at this. So if I take SoFi, I haven't looked at this. 80% probability, it's calculated off the trailing 90 days. When these conditions existed in the trailing 90 days, 8 out of 10 times it produced a 2% gain. That's all we're calculating. But if you looked at this, hitting 10, supply down for 3 days, here's your entry range. If I have a shot at that in the last hour, the probability that this produces a return tomorrow or the next day or the next day is very high, 1 to 5 days. And I really like getting something in the last hour because that's where all the money's trying to get a reference price. The indexes and ETFs, the relationships in the markets between a basket of stocks, ETFs, and options. Options cause the market to go haywire. It's the thing that causes the trouble. But they all are meant to align. It's the reason why Citadel, Jane Street, and Susquehanna, number one, are number one, because they are all making markets in these things. And so the probability is very good. If it comes to you, great. That's my view. And Brian, if you have a different opinion, please feel free.
No, that's my view as well. I just wanted to hear from you on that one.
Here's the next thing I wanted to note. I mentioned, how would you have known that no matter what Tesla reported, you can't bank on this? You can only, I say it's difficult to use demand and supply to trade earnings because things don't do what you expect, and it's because of derivatives. But there is a tell in here about which way everybody is going to go. And the bet is often much more powerful than the fundamentals because, once again, fundamentals as a motivation in the marketplace is 10% of volume. Functionally, assets under management, 70% run on models, 30% are active. Actives have lost $500 billion a year to passives for 15 years. I mean, it used to be essentially all of the money. And today it's not. I mean, all you have to do is pull up any 13F of a large cap and look at the top 25 holders. If there's a pure play stock picker in it, you're lucky. And so that's how the market's going to work. And here's the tell, because you always look at what is money doing into options expirations. Well, we went from 52% short to right into options expirations 38. Well, that tells you which direction the counterparties for derivatives have hedged themselves long. Okay, well, it's probable then that Tesla will rise. And that principle, most of the time, central tendency is true. And you could look at that data and say, okay, well, these things are probably larger than people's reaction to a 71% drop in earnings because that's not what prices Tesla. It's not. It's a basket of equities. It's ETFs that own Tesla, or hundreds of ETFs. And there are derivatives and people who bet directionally on those. And it's very, very powerful. Hedge funds make 2/3 of their returns betting directionally on earnings. So if you made a big, long bet, it will overwhelm a negative response and up the stock goes. So again, I'm not saying that'll work every time, but it's you can always go look and see, particularly if earnings is very close to a monthly expirations period. The dailies, the 0 days to expiration, the weeklies, almost no underlying asset movement. They create a lot of speculative pricing, but that tends not to result in a movement of the underlying equity because the time frame's too short. Why would you exercise and settle and incur all of the settlement cost associated with a derivative if you don't need to? You'd rather just get rid of the derivative. And so it's just something to keep in mind. Okay. Very quickly turning to why I traded long in the last hour of the market Monday. The market's down dramatically and you think, well, what kind of idiot would step in front of that train? And well, I'm not saying I'm not an idiot on occasion, but I am saying that if you looked at the demand side, so we come out of options expirations, and here's Monday, demand's rising, supply's flat, it's below the trend, it's high, it's a source of concern. I mean, I think unless this changes, we will all of a sudden the market will stall. Because there's oversupply. Yes, a portion of this is, for those who don't know, that most large orders in the marketplace today are filled with created stock because high frequency traders, proprietary traders who make markets, two-sided markets, they're making bids and offers, so they receive an exemption. Any broker dealers who are engaged in a two-sided market making are exempted by the SEC from having to locate shares to short because the SEC wants to maintain a continuous auction. Ergo, if there is a bunch of buy orders that come into the marketplace, firms like Citadel will fill them and mark all that short. And we're going to see it in the short volume numbers. So that can happen. But then Citadel's running algorithms looking at its aggregate exposure to every equity. It'll be the basket, the underlying stocks, what ETFs have exposure to this equity, options associated with it, indexes that may include that equity that have options on futures. All of that is exposure, and they're going to calibrate it, right? So they're going to look at that and go, well, now we got to be short a bunch of stuff to offset that risk, and it tends to bring the market down. And so, that's what we think about. But with the market way down, defying the demand trend, Brian and I both were like, I'm levering into that. and it was, I've made money very substantially every day this week. It's been a very good stretch to produce good returns that way. And I'm not gambling. I'm not guessing. I'm looking at the demand supply imbalance and saying that is going to produce upside in the market. Now, again, it can change very quickly. Last thing that I've gotten, Brian, you and I can do the, what's next together. It's this. I mean, if you look at your dashboard, you can begin to see this. This, I track mega caps. It's just everything with 100 billion or more of market cap because it's 65% of market cap, total market cap, believe it or not. And you see that's topped. Now, it doesn't mean it's going to turn over, but it's something to note. That's a lot of market cap, and you can go down across the dashboard now. And everywhere you look, I have an AI portfolio, airlines and cruise ships, big tech, that's on your dashboard too. And you see, that's interesting, I see a little issue, but they're all topping, right? We haven't gotten there in broad sentiment yet. It's at 5.4 and still rising, but it could pop over the red line tomorrow. The rate of change, if you trended that rate of change, it could be there. And that's a warning sign. And so then you want to be very careful. It doesn't mean it happens immediately, but it's nice to have some warning that this run could all of a sudden just run out of gas. I'm not saying that's going to happen, but you always want to be a step ahead. Okay, I think that is all I have got, and I'll hand the baton to you, Brian.
Thank you. One question for you before I take over. Just in terms of the calculation for short supply, how that's calculated mathematically.
So that data, the short volume data comes from FINRA and the exchanges. So all order flow has to be marked long, short, or exempt under the rules. And very small part of the volume is exempt as defined. It's not the same thing as market making exempt. So effectively 99.5% of volume is long or short. Going to be one or the other. And notice it's half of it's long, half of it's short most of the time. It's part of the stabilization mechanism in the market. So we take those reads and we apply some averaging, some smoothing techniques, because a broker could mark 100% of its order flow short. Well, if you just counted it, you could be off a little bit. And what about this platform versus that platform? So we do some averaging, and we've done this a long time. We began running that data day one when those rules were passed. It's the data set associated with what's called the modified uptick rule, Reg SHO Rule 201. And so we have been tracking that data for whatever that is now, 15 years almost, right? Since 2011. We're pretty good with it. It's a pretty good predictive measure. And I think I had another question, right? Max, does a short play work as well as a long play? I always say demand trumps supply. All other things being equal, demand trumps supply. But if demand stalls and supply is rising, high probability, as Barry Norton knows, high probability of producing a return to the downside. I do it all the time. In the broad market, if demand is over 6 and the supply side rises, SPXU, I'm going to short it. I hedge myself, I protect myself, but I have produced some enormous returns that way. And it's not that I'm after an enormous return. I take gains, not chances. I'm quick to take my gain because you can give it back so fast. But that's the way I think of it, Max. Okay, Brian, over to you.
Perfect, thank you. And Gary, you had one comment about the red and green lines, and we mentioned that in the note this morning. So I think I'll go ahead and just start with that concept, and just go to broad market sentiment. So green line, that's 4 from a sentiment perspective, and what you're looking at here is the S&P 500, SPY here in blue, broad market sentiment in green. When it gets to the red line, that's 6 out of 10. The way that I think about it, and I wrote it down this morning, green means go, red means stop. It's just an easy way to think about it. It's a little more nuanced than that, of course, because can sentiment fall well below the green line? Especially when the market's a little dicey. Yes, it did this year. It did back in 2022. We'll show you what that looks like here in a moment. But this becomes a buying opportunity. Anything below the green line becomes a buying opportunity. You can see even in a volatile market this year, what happened? The market posted gains, and we've posted some really nice gains here over the last couple of weeks. It's been volatile. We expected that, but there's been some nice gains. Now, what tends to happen when you approach the red line is the gains tend to level off. This is a great example back in March. You move above the red line, what happens? It takes a little while, but those gains level off. So that's the way to think about it. I think if I remember correctly, I have a spreadsheet on this, but looking historically, it's about 50 basis points when we get above the red line in terms of what the market does afterwards before it goes back below it again. So that's just the easy way that I think about that. A question was asked earlier, and I wish I had a better answer for this. I'll kind of lean on our market participants here. Does anyone have a real easy way of capturing the names here on the spreadsheet or on the daily trading ideas?
Yes,
obviously, you can. You do? Perfect. We'd love to hear it.
So what I do is there are 4 things that I track in a spreadsheet every day to kind of read what I call the MSE tea leaves. And that is, I download the spreadsheet for the momentum. I download the spreadsheet for the inverse momentum. And then I just take my mouse over the trade ideas, both for momentum and low volatility, and paste those into a spreadsheet. And what it does is it allows me to look at individual stocks. So once I have it in the spreadsheet, I'll sort it by 100%. If you look at the stock hood, when it was down at 30 a few weeks ago, it was also showing up in the daily trading ideas. It's 4 times has it been at 100% in the month of April. So it's very easy to see that when you just copy that and download it into the spreadsheet. The other thing that's interesting is we know that we're in a high volatility environment because 9 of the last 11 trading days, there's been nothing in low volatility. And so when I go into my spreadsheet, I can see that. The 2 times that there was something, it was one day there was 2 names and one day there was only 1 name. So in the last 11 days, there's only been 3 names that have shown up in low volatility. So it's kind of a way to let me just kind of read the tea leaves beyond what we have with the graphs and everything.
Sure. Would you mind repeating that real quick, Barry, if you don't mind?
Yeah, no problem. So
Thank
I
you.
have a spreadsheet.
Yeah.
And there are 4 components to the spreadsheet. I download the spreadsheet for momentum. I download the spreadsheet for my portfolio, which is the inverse of momentum, just the exact opposite.
Yeah.
And then I go into daily trading ideas and I just run my mouse over the ideas from the bottom to the top. And I capture all those names and all the data. I paste that into a spreadsheet and I do the same thing for low volatility. And then every day, once it's in Excel spreadsheet, now I can go in and do sorts and stuff, but I can see how things reoccur. What's also interesting, especially in the momentum, is when a name shows up several times, you can begin to see when the entry points are at. Like for trading ideas, you can kind of see how the stock moves just visually right away in terms of its volatility and how that volatility changes also. So it's rather fascinating. I can actually send it to you and share it with you. I can show you what I'm doing.
That'd be great. I appreciate it. Yeah. We had that question. I'm sure Tim has received it as well in the past. I keep a spreadsheet, not as easy as what you're talking about. There, I have a number of spreadsheets, but what I do, and these are the top names from today. It takes me 2 or 3 minutes, but what you just described is a much easier way of doing that. So, yeah, thank you for that idea. I appreciate it. I did want to go for a moment, and it's kind of revisiting a concept. We're trying to paint in broad brushstrokes here, because obviously we've seen a lot of volatility this year. If we look at what the market has done, let's do year to date here. We can see we started off on the SPY up about 592. We're down around 535. So we've obviously come under some pricing pressure. Ironically, pricing pressure started. Where did it start? Options expirations in February, kind of the month-end time frame in March. How does this year compare to a couple of the other volatile years that we've seen in the past? Just kind of a comparison here in terms of what we're seeing. I'm going to run through 2018, 20, and then 22, just looking for perhaps some tells and maybe some things that we can think about, for this trading year in terms of, how do we get out of the woods? What does that look like? In 2018, this was the closest one in terms of it was tariff related volatility, which really hit at the end of the year. Now, for us to get out of that volatility and for the market to start posting gains again, well, look at broad market sentiment. It was fully oversold. We started to rise from oversold conditions, and we had some short covering. It actually wasn't that much, but it was about 5.5% moving lower. Once again, oversold conditions, and I think one key element, it was a transition. We moved from one year to another. So obviously we don't have that right now, but those were some of the other key elements. 2020, coming through the pandemic, a lot of downside, very volatile, down, up, back and forth. We went. It rallied once again when broad market sentiment was very oversold. And in this case, we had significant short covering. Short volumes fell by over 15% that year when we look at that trading. 2022, very volatile year, back and forth throughout the course of the year. When we finally started to rally, a little bit of an inflection point, we had come to the end of a quarter. So September trading transitioning into October trading. Once again, broad market sentiment very oversold. And I think what was interesting here is I think market participants got spooked. Maybe there's a better word that I can use other than spooked. But after all of this volatility during the course of the year, everyone kind of threw in the towel. Everyone went to the same side of that trade. And then that was kind of the signal then, combined with oversold sentiment, shorts got covered and the market, took off, and 2023, 2024 then were good years. Where are we at right now? Well, this is our sentiment rise right now. As you can see, very steep in terms of that movement higher. Notice what's happening with short volume, though, and Tim pointed this out. We're not getting short covering. That was about a 5% decline from its highs, but short volume's already moving the other direction. So in terms of like broad market considerations, what kind of market year is this? Is it 18? Is it 20? Is it 22? Is it a combination of the above? And as I mentioned, recovery during previous years came when we had that oversold sentiment and we had that short covering. Are we there this year? I don't think so. It would be very surprising to me if we were. Limited short covering, short volumes already rising. It sure doesn't match up with what we saw, with some of these previous looks. So, once again, looking at some of the previous times that we've had difficulty, I don't think we're there yet. What type of year are we in right now? Earlier this week, I thought it was more like the 2020 market. I think I'm leaning a little bit more towards 2022, though. I think we're just going to go back and forth here for a little while. That doesn't mean you can't make money. And Tim mentioned on Monday, you can make money in the individual names. You can make money in broad market moves. Take a peek at what happened on Monday trading. I made just a snip of this at the end of the day. This is what Tim and I were trading on towards day end, and it didn't really. And this was about 3% lower during the course of the day. Why did I go long at the end of that particular day? Because broad market volatility, all of it was about 3%. So in other words, we had lost all of the broad market volatility. It was very likely that the market was going to move higher, towards the close. And that's exactly what happened that particular day. So, not only can you trade off of daily trading ideas and, every single day, and there's a lot more opportunities now. It gives you the entry lows, it gives you the entry highs. But, what Tim and I are trying to provide as well is, what's the volatility right now in the market? And I missed it. I think it was yesterday. Yeah, it was yesterday. The market was up, over 3%, I think, at the beginning of the day, which was all of its volatility once again. And I could have taken it the other direction for a short period of time. So just recognize that not only can you trade daily names, but you can also trade sometimes these broad market moves.
Yeah, I would interject that it was such a good move that on Monday, in 20 minutes, I made enough on my SPXL position that I sold it, and I reset them both as market on close orders. If you can, so a market on close order means that you're going to get the average, the reference price of the day. So, I mean, it was so good, such a dramatic move, that I like to take gains, right? It's nice to see. And I did the same trade again. I took those guys, sold Google because it was up 2%. Could have kept it, and reset that trade. Did the same thing yesterday, and I'm looking today. So I'm not sure. So we've started to see it, if the market stayed very near its highs into the close, I would add to my short position and hedge it long. They're closer to neutral. If it retraces substantially, I'm probably keep my long bias because we know what the demand supply balance is in the market. It's still biased heavily toward momentum and demand. But because supply has stayed very high, it can sometimes, as I said, I repeat these things because they're important, can end on you suddenly. So you just want to be prepared and not caught out. The most dangerous ones, Brian, you would probably agree, is if you're trading volatility. If you're long or short volatility, man, those things can move on you double digits, and you look down and you're all of a sudden, woof. I mean, I've had that happen to me. It's unpleasant. I'm hedged, so it's always worked out. But it's really frightening to look and go, like put my position's down 10%, right? You don't want to do that. That's why you always have to be hedged. And I always bias directionally based on the demand supply balance in the market. What's next? And we'll let you go.
Thank you.
Right?
Maybe one or two more items and then kind of look at the path ahead. I did want to talk just for a second about sometimes you see what I wanted to point out was just the magnitude of this sentiment rise. Now that's a little bit unusual. Let me take this back a little bit farther back so you can see, what norms look like. This is more like a normal look where it's rising, or you get into this type of atmosphere. To just move, let's call it parabolic, is unusual. And it's almost like a weather forecast. If you see a parabolic rise in market sentiment, that's usually going to equate to some type of parabolic rise in actual price, for the S&P 500. Obviously, just the same, if you see market sentiment just diving lower, what's going to happen to share price? It's more than likely going to dive lower as well. So just kind of thinking through that, this is like a Maserati going up a hill, right? This is like a Pinto going up a hill, right? There's differences between the two. And if you see the Maserati going up the hill, you want to follow along with what the Maserati is doing. So just looking at some of those magnitudes of sentiment gains. I think I'll go ahead and jump to kind of my ahead look, and then you can kind of jump in, Tim.
Barry, you've got a comment.
Yeah,
Barry's
please.
got please, Barry.
Yeah.
No, before we end, I would just like to take a look at Googleicious. They have earnings, but momentum came off of 10 today. Price is going up, and short volume is at 26.9%. So at some point, I'd just like to comment on that, if we could. Just get your guys' read on that.
Which one? What is it, Barry?
Google.
Google.
Oh, Googleicious. Yeah.
I call it Googleicious.
It's
tough one, huh?
It's as I look at this and say it's got one of the, I would despite how low the supply side is, it's at one of three reasons to leave. But if you compare it to Tesla, it's got long bets, right? If you've used that same same approach where you're looking at what if you use the supply side as your signal. Yeah, I mean that's the one thing. It gives you kind of a contradictory read.
Can you share your screen, Tim?
I can. Yeah. In fact, it was the reason I was quick to take gains in Google, because when you get close to earnings, bets begin to take shape. So here to me are the contradictory signals. This is very low supply as a rule. I mean, when the broad market is at 50% and Google is at 35%, of course it tends to run much lower. That's really low. But this is options expirations. So to rise from 18 to 35 to basically double around options expirations in April says to me that there are some short bets, even though comparatively it's way long. I mean, it's 2/3 long, 1/3 short. And then you've seen these levels come back down to 20, as you said, Barry, it's at 27% now. So then what would one expect from this? You got falling demand. I just would be very careful. If you're, if those, I don't trade options. I trade leveraged ETFs, but if you do trade options, you would certainly want to hedge in the form of out of the money puts and calls, right? If you're gonna have if you're gonna take a directional play here. But what did you conclude, Barry?
I concluded the same thing you did. That's why I wanted to ask the question. I just wanted to say,
Yep.
am I thinking right? It
Yep.
leveled off at 8 and then it came down. And, for me, kind of a red flag to be cautious was momentum converging with price. That with low volume the way it was as it performed into options expiration, I'm like, this is just, it's a signal that it's just too tricky to call.
Agreed. Yep. We concur.
Thank you. Appreciate that.
Okay, we're down to we don't want to keep you too long, so we're down to.
I'll try to do my look here in a couple of minutes and then turn it over to you. So as we mentioned in today's market desk note, we're approaching the red line. I imagine we probably get there today. We can still post gains once we move above the red line, but it's kind of where equities go to stop. 50 basis points is the long-term rule for that. Equities really just don't move higher once we get above that red line. Once again, we are getting short volumes that are starting to move a little higher. I'm going to bring this look back because I want to take a quick comparison to 2022. Couple reasons for that, and this ties back into the longer term view. But look at where we were with sentiment. This recent sentiment decline, moving all the way down to what was that 2.3. You have to go back to our bear market in 2022 to see similar declines in terms of that sentiment read. So that to me makes me a little bit wary that we probably have some downside to go here, and kind of a logical inflection point would be the month-end time frame, especially as we're getting close to the red line. So just be a little cautious. We might have further upside here for a couple of days, but especially be a little bit more cautious as we approach month end.
I agree. I can't really add much to that, so I won't. I agree with you. Yeah. So the net, when we do this again, what is that? Is it the first? Is the first?
It'll be the first. Yeah.
Okay. So So May 30 or April 30, rather, April 30 are month-end options expirations, and the reason these things are very important is volatility is 3%, not 2%. And so that means all this indexed money, all the ETFs they're trying to track the benchmark, and they have to do that, paid more to do it. And the counterparties who are going to supply those baskets, the month ends were created in 2014 by the SIBO, Chicago Board Options Exchange, to help the passive complex track the S&P 500. And it's expanded out from that. But that's the purpose. And so if there's a lot of volatility, it could be imputed into what happens right about that time. It doesn't mean it happens on the day because you don't know. If you got order flow in your systems, could it be the day before? Could it be the day after? In April, the hit came the 3rd, but the cause was before that. It was the immense amount of volatility we had, and then it tipped the market over because all that stuff got expensive. People didn't know what risk to take. So just beware of that. I like to be, if you're going to be in the market, make sure you're protected, that you got some hedge, because wow, it can move on you. And I think if we hit the red line tomorrow, be very careful about next week, in my view.
Mm-hmm.
Yep. Okay, off we go. Have a good weekend. We'll see you next week.